Morning to everyone. Thank you so much for taking the time to listen to us today. The presentation I'm going to be taking you through today is titled Where to from 2021. And in order to answer this question, we briefly just want to take you through how we see the current global macro environment and take you through how we see that translating into the local environment and what that means for local fixed income asset class valuations. But before we do that, I just want to take a minute to reflect on the year that was. We were very proud of the fund's performance for 2021. It returned 9.2% gross of fees. And the majority of that return came from our allocation to local bonds. Bonds had a good year. Nominal bonds returned about 8%, but inflation-linked bonds in particular had a strong year, returning almost 15%. So that was a very strong contributor to the fund's performance. Our offshore allocation did very well, generating 1.8% of that return. So that would be due to our holdings in hard currency. We do take a very deliberate view as to how many dollars, euros, pounds, etc. we hold in the fund. And also the yield that we are generating on some hard currency assets swapped back into rands did very well for the fund as well. We also had small allocation to local property and to preference shares, both which had phenomenal years last year. Preference shares returned north of 40% for the year, and SA property, I think, 37 or 38%. So that also did very, very well for the fund, and overall a very pleasing year for us. I just want to touch briefly on the strategy of the fund and how we manage the fund as a reminder for you all. We follow what is called a diversified alpha approach. And what that means is that we have a very large array of instruments in which we can invest in. We can invest in bonds, we can invest in currency, credit, convertible bonds, preference shares, property. And what we do is we monitor the valuations of all these asset classes consistently. And what we'll do is we'll allocate a very risk-cognizant portion of the capital into these asset classes that we see value in. Generally, this means that we have a very diversified portfolio that have various alpha generators. So if we get one or two calls wrong, it's not the end of the world because there will be a wide array of other asset classes that in that point of time we hope will be firing. We do want to emphasize, though, that we invest in asset classes where we think the risk return is skewed in our favor. We don't feel like we have to be invested in all these asset classes at any one point in time. And should we feel that an asset class is overly expensive, and we believe that's where you generally tend to get burnt, is by holding on to an asset class that is expensive for too long, we are happy to stay away and rather allocate capital elsewhere to where we see more opportunity. So, to answer the question where to from 2021, we just want to remind ourselves and give you some insight into how we see the global macro environment at this point in time. And I think what you've all heard is just how high inflation was in 2021. This is not new. We've all heard it. It was the predominant theme for last year. But I'd just like you to look at the left-hand chart where you can see inflation versus interest rates. And I want you to take note that in the US, which is obviously the dominant global economy, take note as to just how high inflation last year printed. That chart, or both of those charts, goes all the way back to 1939. And you can see that in the more recent history, we haven't seen inflation prints this high coming out the US since the 1980s. What is also very notable is just how low interest rates still are. So what does this mean? Does this mean we can see an increase in interest rates? And that if you look at the 1970s, when you had very high inflation, can we expect to see this very dramatic increase in interest rates to curb inflation? Or is something else at play at the moment? And we naturally believe the latter. And to give you a bit of insight into what we think, we just want to take you through what would be a normal economic cycle. So what happened in the 1970s, for example, you have slowing economic growth, In order to generate economic growth, you lower interest rates. As you lower interest rates, economic growth rebounds, but that also means inflation can spike, and to temper inflation, you then have to lower interest rates, and so this normal boom-bust business cycle goes. What happened at the onset of the COVID pandemic, however, was that interest rates were already very low. There wasn't much that monetary policy could do in order to stimulate growth, given how stretched monetary policy already was. So it is very difficult for this normal business cycle to take place when interest rates are low to start with. So what we've seen subsequently is that because monetary policy was already stretched, in comes fiscal policy. So Treasury ran big fiscal deficits. They ramped up the amount of debt, and you can see on the right-hand chart just how high federal debt has risen over the last few years. And in order to fund that debt, because interest rates are very low and they now need to fund a lot, what happens is that the central bank essentially fund this debt. And in order to fund it, they perform QE, or another word for QE is they print dollars. So this is the current environment in which we found ourselves. And what this means is that this current environment has two impacts. Firstly, it is generally inflationary, and we've seen this inflationary impact come through. And, it is inflationary. And we saw this play out in the 1940s, where in order to temper this inflationary environment, because of this high level of debt, it is hard to raise interest rates. So the Fed is actually finding themselves in an incredibly difficult position where you've got high debt, it's hard to raise interest rates, but you have very high inflation. So taking it back to this 1940 scenario, the environment we see playing out is, yes, of course, the Fed needs to raise interest rates, but we don't foresee that they will be able to do this sharp, aggressive hiking cycle because of the amount of debt and leverage in the system. So we foresee that negative real rates will be in play for an extended period of time. And what that does is that essentially deflates the amount of debt in the system. You run that scenario for a long period of time, and once that level of debt has deflated sufficiently, you then have more room to impose normal monetary policy cycles. So that is the global environment in which we see ourselves in. How does that translate locally? So what we've seen is the MPC implement the first interest rate hike towards the end of last year. They raised the repo rate from 3.5% to 3.75%. And we've seen slight increases in the local inflation print, predominantly driven by high fuel prices. And naturally, the more hawkish tone of all the global central banks has also precipitated the start of this cycle. So the FRA market, we believe, is way too hawkish. They're pricing in about 300 basis points worth of hikes. And the SARB's quarterly projection model is pricing in just over 2% of hikes. We agree slightly more with the quarterly projection model in that we think about 0.75 to 1% worth of hikes in this year, probably followed by another 3 to 4 hikes next year. And the reason why we say we think that's probable given the local environment, but it's very hard to call at this point in time because you've got push-pull factors on both sides. On the one hand, if inflation is as subdued locally as what many people think it is, or many economists believe it is, and if you look at the right-hand chart, you can see what I mean. Yes, we've got the short-term spike in inflation, but we do see forecasts moving back down towards the midpoint of the inflation band. So you aren't seeing this very long-term sharp inflationary pressure locally as what we're seeing offshore. But on the other hand, growth is also a very big problem locally. So yes, they're going to hike, and they probably are going to want to hike as gently and as gradually as they can, given the growth constraints and the fact that inflation is not so problematic locally. But on the other hand, a lot of what will happen is very determined or very precipitated on what global central banks do. If the Fed moves quicker than what we anticipate, then naturally the SARB at the very least will have to move in tandem with the Fed. So I think one of the most notable changes in the fund over the last year has been the increase in our nominal duration, as well as the increase in our linker duration. But the duration of the portfolio is a lot higher than what I'm sure many of our investors have seen for quite some time. If you reflect back on our views about a year or two ago, our duration was lower, even though yields were quite attractive. And the reason why we were quite nervous about government bonds is because we were worried about credit risk. The local fiscus was so strained that we were actually worried about credit risk surrounding the sovereign. So we actually dialed duration back quite a bit. But this picture has changed over the last 2 years. And as a result of rallying commodity prices, the revenue income that we've seen from mining taxes has been phenomenal. So we've seen this massive increase in revenue in our fiscus, and the expenditure side of our fiscus has also been phenomenally constrained, a lot more constrained than what we've seen in prior years. So this combination means that our fiscus is a lot healthier than what we thought it would be even 18 months ago. I mean, if you look at the debt to GDP trajectory, that chart on the right, if you think back to the MTBPS in 2020, that's that top line. That's the debt to GDP trajectory we were expecting at that point in time. It got a lot better in the February budget. And if you now look at the most recent MTBPS, you can see just how significantly better the fiscal position is to what we were previously expecting. There has been a rebasement in GDP. I do need to say that that is also a big contributor to why this trajectory looks so good, but there are a lot of strong underlying reasons for this as well. Now, it's hard to see this consolidation stay long term. We are very reliant on these mining receipts to keep this fiscal consolidation going. But what, at the very least, we can say is that we are not on the edge of this kind of fiscal cliff that we thought we were 2 years ago. We have, at the very least, certainly bought ourselves a lot of time, and the credit risk around government bonds has subsided quite significantly. So we're less worried about the credit risk, and we think the yields are very strong. And the reason why we think the yields are very strong is if you just look at a simple bond valuation model and you look at a 10-year point. If you take the US 10-year real rate, which is a bit higher than what was printed there at the end of December, but for argument's sake, let's just say it's still at minus 1.1. We have long-term SA inflation expectations at 5. We've got a slight risk premium for inflation. And then the balance of that model will be attributed to how much credit risk the market is pricing for South Africa. And you can see just how high that risk premium is. That risk premium, it's now probably closer to 5, but at that point in time was 5.5%. And I mean, that is a phenomenal amount of compensation being paid to investors for a fiscal picture that is as substantially better as what it is. I mean, even at the height of the Brazilian debt crisis, the markets were pricing in this amount of risk premium. So we think there is a phenomenal amount of value in bonds. We generally like the nominal bonds relative to the inflation-linked bonds, particularly on the belly to long end of the curve. We do look at inflation break-evens to assess whether we'd rather be in the linkers as opposed to the nominals. So your inflation break-even is where should inflation be for you to be indifferent between holding a linker and a nominal. So if your break-even is low, you'd prefer to hold the linker. If your break-even is high, you'd prefer to hold the nominal. And given how low the break-evens are on the front end of the curve, we do prefer linkers on the front end of the curve, and like I said, nominal bonds on the belly to the long end of the curve. Just back to the rand, we have seen a significant amount of devaluation in the rand, but the rand came from what we think were exceptionally expensive or exceptionally strong levels. So in order to determine how the fair value of the rand, or a range in which we think is fair value of the rand, we run what is called a purchasing power parity model. So in currency dynamics 101, we deflate the value of the rand by the inflation differential between South Africa and its trading partners. And then we also do what's called a fundamental adjustment. So usually emerging market currencies trade a little bit cheap because generally they are running big current account deficits, fiscal deficits, and see low growth. And that although our current account is in surplus at the moment, we are structurally a current account deficit nation. And for that, generally the rand trades a bit cheaper. So this model was ran at a spot of 1593. At a spot of in about the 1540s. We think the rand is probably fair value, high 15, early 16s. It's probably still around fair value, maybe on the margin cheap, but we would be pretty neutral on the rand at these current levels. And then just to conclude, this is what the portfolio looks like at this point in time. We have quite a significant portion of the portfolio allocated to floating rate notes, where we are getting a very good pickup above money market, about 1.7, 1.8% above money market. You can see our bullish sentiment on bonds coming through in our allocation to SA fixed rate bonds. We have a 12.7% allocation to SA linkers. Like I said, there it's predominantly short-dated bonds. And then we have small allocations to various asset classes like property, we're at 2.7, pref shares 2.9, a very small allocation to SAPI convertible bonds, and the balance is pretty much offshore, where although we have an effective FX exposure of only 6.7%, we have a higher offshore allocation that will hedge back into rands because rand forward points are offering such an attractive opportunity for us in this point of time. What that means from a top level point of view is that we are running duration of 1.4 years. Predominantly that's coming from local SA bonds. And then we've got a small portion coming from SA linkers and the balance coming from our offshore component where duration is very low. Given the rising interest rate environment offshore, we think that is prudent. And on that note, I'll pass over to Doug for some questions.
Thank you, Lara. That was thoroughly comprehensive, and I hope everyone got from that was that I guess SA bonds are really attractive at this point in time. But Lara, I have one quick question before we conclude, is that typically when the US and the Fed hikes its rates, this isn't normally a good situation for emerging market debt.
Yeah.
You have built the case there for an attractive South African bond valuation, and you have added that to your portfolio over time. But in this environment where Fed's rate hiking or hiking its rates, do you see any risks to that investment case?
Yeah, so generally a rising interest rate environment isn't good for bonds, and but I think here, given the steepness of the local curve, what you often see is when, especially if the MPC or the SARB hikes interest rates, generally what it does, it actually anchors your inflation expectations, and you might actually see a flattening of the yield curve. So we think that rising local interest rates might actually do that, and given the steepness of the yield curve, we think that hiking interest rates might actually benefit us, where we are positioned in the belly to long end of the curve to flatten the curve. And even if there isn't this massive rally in local SA bonds because of nervousness around rising global yields, we're happy to be patient. We're getting an exceptional running yield at this point in time, and over time, we don't think that rates are going to move to incredibly attractive levels offshore. We think the system is too leveraged for that to happen. And there is every potential that there's going to be this global search for yield. And in a world where there really isn't much yield, South Africa does stick out like a sore thumb. And we think that there is a very strong investment case for flows to come into South Africa at some point in time.
And very quickly, that's an interesting point you make there, because typically we see the dollar rallying quite hard.
Yes.
With rising Fed rates.
Yes.
This hasn't quite happened as much as I think the market would expect.
Yeah.
What are your forecasts for the dollar?
So with the dollar, it's always difficult to forecast because you've kind of got push-pull factors at the moment. You've got Firstly, let me say that I think we've all been surprised at the resilience of the dollar, given the amount of QE, the levels of inflation that we're seeing. I think the resilience of the dollar has been phenomenal over the last 2 years. So we've seen more hawkish tones coming through from the Fed, but we haven't seen this big rally in the dollar. It's difficult to kind of, draw conclusions from such a short sample. But I think, what's more important is what is the market thinking, or where is the market anchoring long-term US inflation expectations? Because, like I said, currency dynamics 101, if your inflation's running very high, you would expect a weaker currency. But rising interest rates, of course, you would think would move towards a higher a appreciating currency. So I think the direction of the dollar is very much going to depend on how well the Fed does in anchoring the market's long-term inflation expectations. And if that is done in conjunction naturally with the hiking cycle, which it will need to be done, then you would think that would be dollar bullish. But I think the Fed's communication is going to be very important in how that all plays out.
Thanks, Lara. We've had a couple of requests here that whether the slides will be available. I guess the audience have appreciated it, and they will be made. These will be made available on request. And also, I'd just like to just draw your attention to the fact that all of these videos will be available on YouTube. So thanks very much, Lara, for your time. Really appreciate it.
Thank you. Thank you, everyone. Bye.